Welcome to Sierra Capital's Family Office Fundamentals, a podcast dedicated to helping families preserve their legacies and wealth for future generations. I'm your host, Zev Zaretsky, Investment Director at Sierra Capital, a 25-year-old multifamily office focused on guiding ultra-high net worth families globally. In each episode, we'll explore a wide range of topics, including investments, trust and estates, family governance, philanthropy, and much more. Our goal is to provide you with a solid foundation to safeguard your family's financial, intellectual, and human capital for generations to come. Join us on this journey and stay tuned as we hear insightful conversations with industry experts and thought leaders right here on Family Office Fundamentals. Let's embark on this journey together. Please find important disclosures at the end of this podcast. All right, everyone. Well, thank you for joining today. We have with us Joe Alala III. He is the founder of Capitala. Based in Charlotte, North Carolina, Capitala is a firm dedicated to the lower middle market. They're a capital provider, both debt and minority equity. So we have Joe for about half an hour today. And so, Joe, thanks for joining the podcast today.
Hey, Zev. Great to be here. I'm like your biggest fan of your podcast.
Oh, thanks, Joe. I know you listen to it whenever you can during a nice long commute home. But appreciate you being on. Was wondering if maybe you could start with your background, previous work experience, and what brought you to private credit and the lower middle market in particular.
It's actually quite interesting. So, I'm from the Charlotte area where we're based now. I actually went to Princeton. And I did my senior thesis and junior, it's called a junior paper. It's like a mini thesis on small business finance. And it was really focused on different credit type securities for small businesses at the time. So that's what I actually did in college. Then after college, I did a JD and MBA degree at Wake Forest. And I wanted to, I never intended to practice law. I wanted to be in the finance business. And I wanted to stay in the South. So I joined a small group of, a Young Presidents Organization, YPO investors, and we were doing all kinds of great deals, small business deals. And what I learned is, just like my thesis was about, is it's very difficult for small companies to obtain financing. And this is back in the mid-90s.
This was back in the mid-90s in Charlotte.
In Charlotte. So I finished law school, business school in 96, started working in 96. And I realized it was a big struggle. And the most difficult part for these small companies was really that mezzanine strip. So you had a bank that would do some, you had that strip between the equity and the bank debt of mezzanine. And that was very difficult to obtain back in the day. There weren't as many SBICs. It was just a very difficult piece of the capital structure. Even though we don't do mezzanine nowadays, but this is back, it was 25 years ago. So I decided to launch an SBIC, and that is a sort of, we'll talk about this more later, a public-private partnership with the Small Business Administration, which really sort of tries to encourage the flow of capital into small companies. So in 1998, I started our SBIC. It took us a couple of years to obtain the license. At the time, I was the youngest person to ever receive SBIC license. And we still do have SBICs in our firm today. And that enabled us the ability to take money that we raised from our investors. And at that time, it was mainly individuals. I think we had one bank or two banks in our first fund, but mainly individuals. Most of those individuals I had worked for in that YPO investment firm. And then we'd match that with government funds, and we'd take that and provide capital to these small businesses. So we received our SBIC license in 2000, did our first deals in 2000, and sort of here we are, 25 plus years later, still invested in small companies, have done, about 200 deals and invested about 2.3 billion into small companies since then. So still in the small business world, love it every day. And even today, especially today with this current credit crisis, it's very difficult for these small companies to obtain financing.
Yeah, especially there's plenty of ways for businesses to grow. They just need the capital to do it. The I guess just to kind of dig a little bit into the firm. So firm started back in the late 90s, early 2000s, right? Um,
Correct.
how's the firm changed over time? And like what's the primary focus of Capitala?
Yeah, so, started in 1998 with the mission is to help small businesses obtain financing, right? So that part has not changed, but how we go about that has definitely changed substantially over time. So, we started with our first SBIC fund, and then we raised like a couple more SBIC funds. And then we took some of our vehicles public and formed a BDC, which is a business development company, a publicly traded one. And then we started raising non-SBIC funds. And then we started becoming onboarded to a bunch of big platforms, like Hamilton Lane, Stepstone, Morgan Stanley. So we sort of grew beyond the small business world for a while, but always sort of maintain our focus, in the small business world. And we started with a pure mezzanine strategy, mezzanine and warrants, which turned into sort of mezzanine and equity investment over time. And then I'd say the last 8 years, we've actually moved that strategy even more into it's basically a unitranche cash flow lending strategy with equity co-invest. And that's sort of over 25 years, that's where we've landed, where we think that's the optimal place to be on the capital structure for these small companies is a cash flow loan, 2 to 3 turns deep, maybe a little more, and then providing that equity infusion. So we've been out of the mezzanine business for about 8 years now, and are just totally focused on unitranche, cash flow lending, and equity co-investment.
Yeah. Well, so I guess could you touch a little bit on the actual businesses or like the target clientele for the firm? And maybe you could do so by just like walking through a typical deal, you know? Like what does the company do? What are these companies trying to accomplish? And what is it specifically that you guys are providing them?
Yeah, so our typical deal is going to have between 3 million to up to 20 million of EBITDA. They're going to be a small business. And what we don't do a lot of is what's called sponsor financing, where a sponsor, like sponsor in Florida signs a deal and needs capital. We will do some of that, but that's not our primary strategy. Is we help companies with growth capital. So, for example, a company wants to buy another company or buy out a partner or enter a new market but need some capital. We'd provide that growth capital, or we do a lot of independent sponsor activity where, a talented independent sponsor finds an opportunity and they have to put together the capital structure for that opportunity. So we help them with every part of that capital structure. We'll do the debt, we'll do the equity, anything in between, other than mezz, of course. So that's our typical deals now, and I think like a deal that we just recently invested and exited. So over the past 2 or 3 years, is the HVAC roll up. So the company started. We sourced the company through one of our YPO connections. It was doing about 5 million of EBITDA, but part of that strategy, it was mainly HVAC repair and maintenance, was to roll up different HVAC companies throughout the South and become a bigger company primarily through add-on acquisitions and then through integration. So we put in equity and debt into that company. We grew it over 2.5 years from 5 million of EBITDA, did about 7 acquisitions to about 15 million of EBITDA. And we just recently sold it last quarter to a private equity company. And we sold it for, I think, 14 times EBITDA. And we made like 3 times our money on the equity and then made the debt return of whatever that was, like 14%. So that's one of our success stories that we like to always discuss our success stories. But that was a recent one that closed in March. A great deal. And that's sort of our typical deal.
Yeah. Well, so what's like your target market for like types of businesses? So HVAC being, that's yeah, business service type of business. Um, no, yeah, like are you guys doing things in manufacturing? Are you doing things in healthcare or like just what sectors in general?
Most of our like we don't do real estate. That's sort of an SBA from our SBIC roots. We don't do real estate, and we don't do a lot of consumer direct. So think retail, restaurants, direct to consumer strategies, and we don't really do energy. But other than that, we're generalist. But where we find ourselves spending the most time are business services, and that would include healthcare. So think like HVAC, that was the business services. Um, do a lot of healthcare services. We do some niche industrial manufacturing. One thing that's pretty consistent with our portfolio is there's not a lot of assets there. Because if a small business has a lot of assets, they actually have more options for financing from the banks and other asset-based lenders. But it's when the small business is really seeking cash flow lending and equity where they have to move away from the asset-based lenders in the traditional banks, community banks, regional banks, super banks to find that financing. So that's where we really play. We don't do asset heavy deals and we don't do low margin deals. Think a distribution company. Not every distribution company is low margin, but most distribution companies are, sort of sub 10% EBITDA margins, and we don't really participate in those. But that's what we're seeking. And our current portfolio is almost all business services, and that would include healthcare services.
You brought up a good point talking about, like banks and how they're predominantly like asset-based lenders. Like obviously there's been significant events like, collapse of SVB and First Republic and like a lot of these, ultra high net worth and like somewhat private banks. How have these events in general, or even just like deposits flowing out of banks, how has it influenced the private credit space? And like what shifts have you seen in the market today versus say 5 years ago?
Well, today, we're in a much higher interest rate environment than 5 years ago. So for many years, as you know, we had a very low interest rate environment, which is not the case today. And most of the banks that sort of participate to a large degree in the small business world that where we see are not the super big banks, but the more the regional players. I think what has happened is, um, a year plus ago, Silicon Valley Bank had their issues, and then you mentioned Republic Bank and others. It's really, and it did cause some flight of deposits from smaller to medium sized banks to larger banks, and they've got all this new regulation coming out. So it has created what I like to call as a credit crunch for small businesses. So the banks are not being as aggressive; they're not lending as much to small companies in the current environment. And then on the other side, the small companies are having to pay more for those loans anyway because the rates are much higher. So this has all created a sort of a credit crunch where you can't obtain as much debt financing as before, and when you do obtain it, it costs a lot more. So we're out there serving that need of trying to provide a cash flow loan of a very reasonable amount to a small business, and we plug the gap in the capital structure need with equity. And that's really what's unique. A bank can't plug that gap with equity. They
Right.
can only get you so far. And most of these small businesses would not qualify for a traditional bank to come in and loan them three times cash flow without any hard assets. I'm not talking about personal guarantee or anything, but on a standalone basis, most of the banks aren't providing three times cash flow loans right now to small companies. So we can come in, solve that three times cash flow loan, and invest equity. And but we don't compete with banks. And this is what's very important. We complement banks. So we have about 70 banks on platform as investors. And we do that through our SBIC structure. So we find a deal or they find a deal, actually. They bring us in the deal or we bring them in a deal. And let's say it's a $10 million EBITDA company and they're looking for $40 million. to make an add-on acquisition or maybe to enter a new market, need some growth capital. So we would do a 3 turns loan on that company. So when I say 3 turns, 3 times 10, a $30 million loan. And we take that same loan and come back to the banks, our investors, and ask them to take 10 million of that $30 million loan in a first out structure. And then we'll take 20 million of that loan in a last out structure. This is not mezzanine. This is all in the unitranche structure, very different from a mezzanine structure. And then the bank also would keep the banking relationship and provide the revolver because we don't provide working capital lines. And then the other 10 million, so that's 30 million. 10 by the bank, 20 by us, all in the unitranche structure. Then the other 10 million we invest as equity into the small business to get to that 40 million number. So banks really appreciate us because we help them. They don't mind loaning 1 turn of EBITDA deep into a lot of these companies. Most of them, I don't know of any of them right now that we work with, would go 3 turns deep. That would be in that example, the entire 30 million. But they're fine with doing the first turn of EBITDA at 10 and then providing a revolver and obviously taking all the banking needs of the company. So we complement banks. And in fact, we get a lot of our deal flow from our bank investors.
Yeah. Yeah, that's definitely a cool it's one thing I like about the unitranche structure. It's more of a partnership with your investors than, you're going out there and trying to win the same deals that banks are going for as well. But you did talk briefly about the public-private partnership with the SBA. So banks are allowed to invest in SBIC licensed funds. Many of your funds are SBIC licensed. And so what's kind of been your experience working with the SBA? And I guess generally, how has that public-private partnership helped your firm?
Well, if it weren't for the SBA program and the SBIC program within the SBA, we wouldn't have started in the same fashion because it's hard. And back then, it's a little different in 1998 than it is now. Now the bar is so high to start an SBIC. It was much lower. Unfortunately for us, it was much lower in 1998. But that's what the whole program. The program has been around since I think 1956. But it was trying to encourage capital flow into small businesses. But they do want private money. That's the private partnership part of it to have capital at risk so they can be aligned. So the way that program typically works is the private fund would raise a pool of money, and then the government matches that 2 to 1. So if you went out and raised $50 million from banks or any investors, the government would match it with a 2 times loan, so it'd be 100 million, and it's at very attractive rates. It's at the 10-year rate plus about 100 basis points and some sort of drawdown fees. So it's attractive. So then that private partnership would take that total capital, 50 million they raised on their own, 100 million loan from the SBIC program. They take all 150 and go invest that into small companies. So it's been a very successful program over the past 60, 70 years. I mean, some of the bigger companies in the world, I'm sorry, in the US and world, were funded by SBICs at some point. I think Apple's one. I think FedEx was one. There's many examples on their sort of wall of fame in the SBIC offices of small businesses that used SBIC funding at one point, and now they're $1 trillion valuation. So it's been a great program. The government, it's a high bar. It's a very high bar to get your first SBIC license now. And they sort of really maintain that sort of performance expectation to stay in the program, because just because you get one license doesn't mean you'll get another one. And it all depends on your performance. And there's many funds that don't last for many licenses because either they retire or the performance isn't good. And, we've been in the program 25 years, and this is our 5th license. Very proud of that. So it's been a great program. We're sort of unique in that we don't use the government's leverage anymore because we've sort of outgrown it. because the program right now, the max they will loan to any one fund is 175 million. And remember, you can't be more than 2-to-1 leverage. So, we're raising a $500 million fund. At 500 million, we don't optimize a 1-to-1 leverage ratio with 175. So we actually employ traditional bank leverage, a NAV facility that's also provided by our bank LP. So, we've created this ecosystem with banks. They loan us money at the fund level. They also bring us deals at the fund level. We bring them deals from the fund. So we've created this ecosystem with these 70 banks involved with us that really sort of has created this niche that we're serving that really supports banks in this cash flow lending and equity investing way.
I think that's one thing that a lot of banks want, right? Is first of all, deal flow is number one when you talk to any commercial banker or any bank president. But then also, I know there's a lot in regards to, CRA credit. And just because you're licensed, all your deals have to fit the SBA requirements for being a small business. And by doing so, you're able to then get CRA credit for all your investors. So do most of your bank investors, do they all participate in, taking CRA credit, or what's been your experience on that side of the house?
Yeah, so the CRA is important to banks, especially with these new proposed regulations that have come out from post SVB. And SBICs are included in a CRA approved asset. It comes under the investment test. So any bank that invests in an SBIC, small business investment company, they get CRA credit for their commitment. So you put in $1 million, you get credit day one, even though it may be a capital call over many years. You get $1 million CRA credit under the investment test day one once you make the commitment. And also, if the fund that you've invested in, which they should, they also do deals in your footprint. So if they do deals in your footprint, then they also get what under the community test more CRA credit for those deals. So it's a very CRA friendly investment for banks. And with the new regulations, which you're probably more of an expert on than I am, it actually encourages this even more. So, what they don't want to, what the regulators don't want to happen is they don't want to have just sort of 6 big banks in the country. They don't want to be the European model. But they do realize that 4,000 banks, that some of the smaller ones probably need to consolidate. When I say realize, I'm just saying this is what the regulation sort of thesis is post SVB. So they're trying to promote sort of consolidation and of banks with these new regs. But what they don't want the banks to do is lose that community focus. They don't want banks leaving funding of the community community purposes, and within that are small businesses. So that's what these new regulations are out. I know they're being challenged, but I think they're going to get approved. And it really promotes small business investing through these SBICs with CRA credit.
Yeah. Um, I guess to kind of shift gears. So this will probably be like the last question I got for you. This has been awesome so far. So the current environment when it comes to underwriting new deals, a lot of, we've got a strong US economy, you got inflation that looks like it's coming down, but I don't know, a lot of businesses that I talk to on a daily basis, they're fighting to keep margins where they are, and like so some businesses are growing, especially if you're in tech or AI or anything like that, but the rest of the market doesn't seem to be growing as fast, and seems to be like hitting their own guardrails. So how is it that you underwrite deals in this environment versus in the past? What is it that you guys are looking for?
Well, that's actually a great question. I agree with you. I mean, it seems like this economy has been resilient, but we still see some stress, right? And it's got to have more. Well, it doesn't have to, but we forecast more stress in the future because it's just the cost of capital has gone up so much with higher rates. So what we started doing 2 years ago um, is really focusing on, what kind of capital structure does well in a downturn. And what we decided and how we continue to underwrite for that period of time is you want lower leverage than normal, which is what we've done. I think our average leverage now is about 3x. I would say, pre interest rate rise is probably 4x. So we've come down some on the leverage. And I would say we're really focused on high EBITDA margin companies because I do agree with you 100%. I think there's got to be compression there. So we feel better if a 25% EBITDA margin company is in your portfolio versus a 10% because you can have some compression there and still uh, be fine operationally. So in our current portfolio, our average EBITDA margin is about 28%. And we won't take anything through committee that's under 15% EBITDA margin. Whereas 2 years plus ago, those weren't the case. I believe our average EBITDA margin, back then was probably 15 to 16%, and we go to committee at 8 to 10%. So we sort of heightened the margin profile we want to pursue and lowered the leverage. But I agree with you 100%. I think there's got to be some kind of downturn in the future, but I've been saying that for a while. I'm like Jamie Dimon. I've been saying a recession's coming for like 2 years now, it seems, but not yet.
Yeah, but at least you're still doing deals, and but you just have to underwrite them a little bit differently and be a little bit more prudent. That's at least you're doing it the right way, at least for now.
Yeah,
So
and I think that what's plugging the gap currently is, you know, with the lower leverage and higher rates, is more equity in the deal. So we're even providing the equity ourselves. But if it's an equity sponsored deal, they're just providing more equity as a percent of the capital structure than normal. And because you want to still do great deals. And even though you may factor in a downturn in your hold period, you still want to do great deals.
like, how much equity do you typically take in a? I know the example that you gave us before was 30 million of debt, 10 million goes to a bank, 20 million sits with Capitala, and then how much in equity? Does it be like
So
no?
that's about the right ratio. Is in that example, we were putting 20 of the last out debt and 10 of equity. So we're about one part equity to two parts debt on average. Now,
Okay.
some deals we have to do a little more equity because you know, maybe the transaction needed more equity. And some deals we may do less because it didn't need as much. But on average, we're going to have one part equity to two parts debt.
And what's the use of the capital? Is it mostly for acquisition or is it for organic
A
purposes?
lot of it is add-on acquisitions, but some of it's just sort of maybe taking out some partners. We do a lot of family-owned businesses or entrepreneur-owned businesses that started with three partners. One partner sort of taking the lead and wants to buy out the other two partners. But you got to give them fair value, and that to do that, you're going to have to leverage the company a little bit and use some equity. You buy them out, and we do a lot of that funding.
Yeah, that's cool. And then what geographies do you typically focus on?
Uh, we'll go all over the U.S. I would say our biggest states are of active deal activity right now. It's Florida, then Texas, and I think California's third. I mean, it's sort of you follow the population of the state and the deal activity. So I think our current fund is actually almost too concentrated in Florida. We have 40% of our deals in Florida.
Yeah. Okay, so it's not even though you're sitting there in Charlotte, you're not doing every deal in Charlotte or
No,
In the
remember
Carolinas.
we have 70 banks. They're throughout the entire US. In fact, just to close our first deal in North Dakota. But so these banks are bringing us in on deals. I was in Texas last week. One of our Texas LP banks brought us in a deal, so I went out to visit it with them. So we will go wherever the banks bring us deals, and if it's North Dakota to Florida to wherever, we'll pursue anything in the U.S.
Yeah, that's great. All right, cool. Um, I don't know if you have any, additional like final thoughts you want to kind of give the listeners of the podcast. All of course, let people know how to contact you, etc.
No, my final thought is I love your podcast. Thanks for having me on. Um, And one thing I just want to remind people, one thing that we do is we're really focused on small businesses, but even niche small businesses like veteran owned, minority owned, and women owned small companies. I was just also in Texas last week at a veterans conference. So if you bring us a small business, we're going to work hard to finance it. And if we don't know who's going to finance it, we often introduce it to others. Maybe it's an asset-based lender, or maybe it's a veteran-focused private equity early stage fund. We will work very hard to try to help that small business find capital. So that's what we do. We believe in our purpose here.
Yeah, look, and I think that like a lot of people talk about the political risk. Oh, it's the SBA. Like, who knows what's going to happen? But at the end of the day, it's very bipartisan. Democrats, Republicans, they all want to help small businesses in the country thrive and be a lasting driver of the economy. So I think that firms like yours are definitely needed. And yeah, and obviously appreciate your time and look forward to catching up after this.
All right. Zev, appreciate you. Thank you.
Thanks, Joe. Talk to you soon. The information presented in this podcast is the opinion of Sierra Capital and does not reflect the view of any other person or entity. The information provided is believed to be from reliable sources, but no liability is accepted for any inaccuracies. This is for information purposes only and should not be construed as an investment recommendation.